Hello everyone and welcome to edupediaworld.com. I am going to teach you the first subject, the first paper at the CPT level, that is the fundamentals of accounting. And today we are going to discuss the basics of accounting, the very initials, the very basics of the subject of accounting, how accounting starts, and then later on in the next class we'll start with the chapters of this subject of fundamentals of accounting. So let us start this new journey of fundamentals of accounting, paper 1 of the common proficiency test conducted for the very prestigious course of chartered accountancy. Let us start. Today, in this very first class of this subject of fundamentals of accounting, we are going to discuss the very basics of accounting. That is to say, we are going to have an introduction to this term of accounting. What does accounting mean? How does it start? What are the basics of accounting? And what are the various steps of accounting? So in today's class, we are going to discuss all these things. Let us start with the first topic in accounting, that is how the life in accounting starts with a transaction. The life in account starts with what is called a transaction. A transaction is an exchange. For example, you go to a shop and buy a pen. So the money is exchanged for a pen. You pay the shopkeeper the money and the shopkeeper gives you the pen. So this is what is a transaction, the exchange of things. Transaction means the exchange of values, exchange of things, exchange of the services also. For example, you go to a doctor, the money is exchanged for service. So in case of a pen, it was a thing, an object which was exchanged for money, and when you go to a doctor and avail his services, it is the service which is getting exchanged for money. So these are the examples of what is a transaction. A transaction is an exchange for money. So transaction means if we are exchanging our money for some other value or some other object or some other service, then it is called a transaction. From these two examples, we can form these two rules of transaction. And what are they? The first rule of a transaction is that it needs to be in terms of money. So this is the very first and very important ingredient for a transaction. And what is that? That is, it needs to be in terms of money. Until and unless we are exchanging the things or the services in terms of money, it will not be called a transaction. Rather, this transaction cannot be accounted for. So if you want to account a transaction, record a transaction, then it has to be in terms of money. So this is the very important and very first rule of a transaction. Secondly, transaction must have two sides. In the example you saw that for buying a pen you need to give money. So you are taking the pen and giving the money. So two things are happening simultaneously for a transaction to occur. You are taking the services of the doctor and you are paying him the fees. So you see that until and unless the transaction is having two sides, it cannot be called a transaction only. If you are just giving money and not taking the pen, or if you are just paying the fees and not availing the services, it cannot be called as a transaction. So for a transaction to occur, it must have two sides, giving and taking. These two things need to occur simultaneously for a transaction to happen. This is called the dual aspect. That's why we call accounts as double entry bookkeeping. So here we get to know that the accounting that we'll do will be a double entry system. it needs to have two sides. Until and unless a transaction has two sides, it cannot be accounted for, it cannot be recorded in the books. So it needs to have two sides. So what are the two rules? Number one is that it needs to be in terms of money. Until and unless some monetary value is attached to a transaction, it cannot be called a transaction, it cannot be accounted for. And number two, it needs to have two sides, giving and taking. Both should occur simultaneously. And this also is very much required for a transaction to occur and for a transaction to be recorded for, accounted for. So just remember these two golden rules of transaction. Now, after the definition of transaction, we come to the second basic definition in the world of accounting, and that is an event. What do we mean by an event? An event is a result of number of transactions and it has to appear in balance sheet. For a transaction, we understood that it is one-off, that is, it occurs just once. So anything is happening once, it is a transaction. But an event is a result of a number of transactions happening over a period of time. So it is a sum total of the transaction. Transaction is just, it happens just for once. For example, rent paid, purchases. This is happening just once. I'm paying the rent, I'm purchasing the goods. So this transaction is happening. I'm taking some place on rent, using that place, and in return I'm paying the money. So this is a transaction. I am purchasing goods for resale purpose and paying the money to the person from whom I am purchasing. So this is a transaction. So these all are occurring just once, one time transaction. But an event is the result of the number of transactions. So you can say that I am purchasing goods and selling them, and after the end of the year I am left with some stock. So that stock is an event for me. It was the result of the number of transactions during the year. And what were those transactions? The purchases and the sales. After the round the year purchases and sales, I am left with some goods, and that will form my closing stock. So that is an event. So you understand the difference? Transaction is one-off, that is, it just happens once, whereas an event is the number of transactions, sum total of the number of transactions occurring during a period of time. For example, the profit for the year. The profit for the year is an event because round the year I did my business, I purchased, I sold, I incurred some other expenses, and everything I did to come to one figure at the end of the year, that is the profit. So how this profit came? It was the result of the number of transactions which I did during the time period of the whole year. So the profit for the year is my event. Closing stock, as I discussed just now, result of the number of purchases and sales. So you see that these events are recorded in the balance sheet at the end of the year. All the events which we come to at the end of the year are recorded in the balance sheet in this world of accounting. So these are the two basic terms from which the system of the life of accounting start. What are they? The transaction and the event. First of all, the transaction happens, and with the time, the passage of time, lots and lots of transaction happens, and the sum total of these transactions becomes an event, and these are recorded in the books of accounting, the transactions and the events. And now we'll understand the steps of accounting, how the accounting is done step by step. What is the first step, what is the second, third, and so on. So let us see what are the different steps of accounting for these transactions and events in the books of accounts. The first step in the process of accounting is accounting for the transaction in the books of journal. Journal is the first step in the accounting. Whatever transactions we are doing, whatever transactions the business is entering into during a year are first of all recorded in the journal. The journal is a book of original entry because the first place where the transactions are recorded is the journal. As soon as the transaction is occurring, it is recorded in the journal. So it is a book of original entry. It is known as secondary book. It is known as secondary book because from these books the primary books are prepared. So this is called a secondary book. Just because this is just for the recording purpose, but the main books which shows the position of the business and which shows us how the business has been doing around the year are the primary books, we can say. But those primary books are prepared with the help of this journal, so it is very important. Next slide we'll see how the journal looks like. So let us see how a journal looks like. This is how the journal looks like. It consists of these columns, and this is how it is represented in the books. We have the date column, the account name column, the debit column, and the credit column. In the date, we enter the date in which the transaction took place. Then in the account name, we first of all enter the account which needs to be debited and enter the amount in the debit column, and then in the next line we enter the account to be credited and in the credit column the amount, and then we give the description of the journal entry. So this is the general format of a journal entry, how it is entered in the books. Next comes the ledger in the accounting cycle. From the journal, the transactions are posted in the ledger. So when the transaction takes place, first of all it is recorded in the journal, and from there they are posted in the ledger. All entries in journal are posted in the ledger. Ledger is known as the principal book. The journal was known as the secondary book, and the ledger is known as the principal book, and it consists of 8 columns. So in the next slide we'll see how exactly a ledger account looks like. This is how the ledger looks like. First of all, we have to give the account name. For example, here it is given as cash. So suppose this is a cash account. We give the account name. If we follow some numbering system of the accounts, we give the account number. So here it is given as 001. And then we draw 8 columns. 4 columns for the debit amount and 4 columns for the credit amount. We have date, explanation, reference, and debit. In the date column, we post the date on which the transaction took place in the journal. So that date only is posted here. In the explanation column, we give the account which is debited, and in the reference column, we give the page number of the journal in which the transaction was recorded, so that we can refer the journal by the page number given in the reference column. So it is easier to refer to the transactions in the journal which are posted here. Cross verification is very easy with this reference column. And then we enter the amount in the debit column. Same way, the credit columns, the date, the explanation, that is the particulars of the account which is to be credited, the reference number, that is the page number of the journal on which this transaction was recorded, and the credit amount. So this is how the ledger looks like. This is only one account. All accounts are required to be prepared in this format only: the account name, the account number, and these columns. The third step in the accounting cycle is the preparation of the trial balance. After the journal ledger comes the trial balance. From the ledger, the balances are extracted to the trial balance. So when all the entries are posted into the ledger from the journal, those balances are then extracted into the trial balance. The trial balance is a statement. It's not an account. It is just a statement to check the arithmetic accuracy of the accounts. We post all the debit things on the debit side and all the credit items on the credit side, and then we see whether both the debit side and the credit side is equal. So this statement of trial balance is prepared to check the arithmetical accuracy of the various amounts posted. If there is a difference between the debit side and the credit side, it shows that we have committed some mistake while posting from the journal to the ledger, or maybe we have committed some error while recording the transaction only into the journal. So this statement help us in recognizing the mistake, if any, we have done while recording the transactions in the journal or the ledger. So the purpose of preparation of this trial balance is to find out the arithmetical error, if any, we have committed while recording the transactions into the journal or the ledger. So let's see how this trial balance looks like. Now this is how the statement of trial balance looks like. We enter all the account names in the accounts column, for example cash, accounts receivable, prepaid rent, inventory, etc. All the accounts, whatever accounts that we have created in the ledger, all those accounts will be entered under the accounts column in the trial balance. And then we have two columns, debit and the credit. The account which is having the debit balance will be entered in the debit column, and the accounts which are having a credit balance will be entered in the credit column. And then after entering all the amounts, we do the totaling, and we have to find out whether both the amounts tally or not, the debit side and the credit side. If they are tallying, means arithmetically our transactions recorded in the journal and the ledger are correct and we can proceed further. But if we find any difference and the trial balance is not tallying, that is the debit side and the credit side is showing some difference, then we have to again go back to our ledger and journal to find out what is causing this difference, and then again correct them to tally this debit side and credit side of the trial balance. So this trial balance help us in locating any error, if any, we have committed while posting various transactions into the journal and the ledger. So this is a example how trial balance is prepared. We are going to prepare all these journals, ledgers, trial balances in the chapters to follow. This is just an example. So just have a look over it, and in detail we are obviously going to study them in further chapters. And now we go to the next step of the accounting cycle. This is the last step in the process of accounting, that is the preparation of the final accounts. So from the trial balance, the trading and profit and loss account and the balance sheet is prepared. So the P&L account and the balance sheet is the last step in the preparation of the books of accounts, and these statements give us the performance, help us in assessing the performance of the business, that how the business has performed in this year and what are the expenses, what are the incomes, everything in brief is given in this P&L and balance sheet. So these are the very important part of the accounting system, the preparation of these things, the profit and loss account and the balance sheet. The preparation of trading P&L account and balance sheet is called the final account. The final account is the last step for the accounting process. So let us now see how the P&L and the balance sheet looks like as a part of the last step of the accounting process. This is how the statement of profit and loss looks like. It also has 4 columns. Number 1 is of the particulars, that is gives the description of the amounts entered, the various incomes and losses we have registered over the year in one financial year, that is given the description. The note number, we have to give the note number because this is only the summary, and in note number we have to give the full description of how this income was earned or how this expense was incurred. So the note number is given, and then we have to first give the figures at the end of the current reporting period, and lastly we have to give the figures at the end of the previous recording period. So we have to give the figures for both the years, the previous years and the current year, so that we can compare the figures, whether the income we are earning is increasing or decreasing, the expenses are increasing or decreasing over the years. So it helps in the comparison purpose. So this is how the statement of profit and loss looks like. Next comes the balance sheet. Format is the same as profit and loss account. Here also we have 4 columns, the particulars, the note number, and the figures at the end of current reporting period, and the figures at the end of previous reporting period. So the format is same, just that the particulars are different, in that we record the incomes and expenses, and in balance sheet we record the assets and liabilities. So we record all the liabilities and assets, and in the note number we give the description of all those assets and liabilities. Like for example, if the shareholders fund, we are giving note 1. So in that note we will describe what does the shareholders funds consist of in detail. So the notes give description of the particulars given in the balance sheet. Here it is just the amount is given, but in the note the whole description is given. So the note number is very important because it gives us the full description of how this figure was arrived at, which is showing in the balance sheet. And then we have figures at the end of the current reporting period and figures at the end of the previous reporting period. So this is also serving the same purpose, that is the comparison purpose, whether the assets are increasing or decreasing, or the liabilities are increasing or decreasing as compared to the previous year. So this is the format of the balance sheet prepared as per the revised Schedule 6 of the Companies Act. So this is how the accounting cycle works. First of all, a transaction occurs, that is we exchange something for money, and thus the transaction is taking place. We record that transaction as and when it happens into the journal, and from the journal the transaction is posted in the ledger, and from the ledger the transactions are extracted into the trial balance to check the arithmetic accuracy, and then from the trial balance the balances are transferred into the trading account and the P&L account as well as the balance sheet, and thus we complete our accounting cycle this way. This is how the cycle works. The trading account, P&L account, and the balance sheet is the last and final step in the process of accounting, and these two statements shows us how the business has been doing in this year. So they are a very important part of this accounting cycle. So as we proceed, we'll just understand and we'll study all these process, all these steps in detail in each of the chapters that will follow: the journal, the ledger, the trial balance, the trading account, P&L account, and the balance sheet. All these topics will be covered in detail in this subject of fundamentals of accounting. Hope you understood this introduction, and now we'll continue with the chapter number 1 of the subject of fundamentals of accounting. Thank you students. Thank you for watching the video. Hope you found this class worthy, and hope you have developed the concepts and the basics of accounting. Thank you.